Well, it's 4:05, and my name is Ivan Weir. I'm from the business school. I have retired for some years, but I still do quite a lot of teaching. And one of the reasons I do that is that I've never been just confined to economics. I've always been doing things outside economics or even outside the business school. Recently, Tuesday, I did a whole day's teaching in marine sciences because I worked in the past with the marine scientists quite a lot as well. I'm not technically an accountant, so this is an economist looking at accounting, but I know enough accounting to teach the basics, and that's why I get put onto courses like this. And it's a nice way to earn a little bit of money on top of my pensions and so on. So today I'm doing two sections. We'll have a little break in the middle if you have to get out for anything briefly. Today, two sections. One is basics of accounting, one which is what we normally think of as accounting when we look at a company's accounts. And the second part will be looking at the kind of financial ratios that people use to assess a business performance. Then the second slot I have in a week or two, a couple of weeks' time, I think, is an area shared across management accounting, finance, and economics, and that is the appraisal of investment projects. So we look at the standard framework and techniques for appraising a new investment project or any kind of investment project. We're usually thinking of real physical investment in plant machinery, plant property, plant equipment, and so on. Much of the same sort of things apply for financial investment, investing in government bonds or investing in financial securities, that sort of thing. So that's the menu for a couple of sessions, and we'll start with the basics of accounting. As I say, I'm looking at it from a fairly broad point of view and actually commenting on accounting rather than just trying to set out the basis of a firm's accounts. So we're looking at organization, we're looking at money, finance, and accounting. Then at the starting actually with the accounting system of a financial organization like a bank, and then moving on more generally, and I'll be using the liabilities and assets approach to a particular company, which is BP, the big oil company, and I've just updated my notes to the latest BP accounts, where BP, of course, is making a loss at the moment because of its great disaster in the Mexican Gulf with its spill. It's still paying out vast amounts of money for that. Accounting is information, and then the difference between financial accounting, which is what we're doing today, and management accounting, which is what we'll do next time in that area between economics, finance, accounting. So that's this menu. First of all, business structure. There are several dimensions to business structure. There's the economic structure that economics textbooks divide the agents in an economy into those that are monopolies, oligopolies, a few big organizations competing, we hope. Monopolistic competition, which seems to many people a contradiction in terms, but it's almost all business. Every big or sizable business has a certain degree of monopoly power. That means it has some power to fix its own prices within limits of how much competition there is. It's not technically allowed to fix its prices in conjunction with other firms, but there are few enough firms, there are usually not few enough firms in monopolistic competition to get together. Oligopoly is a few big firms, and they, of course, always are tempted to get together and collude and fix prices and so on. And then the extreme textbook competition idea is perfect competition, where there are just so many suppliers and so many people going to buy products that no one business has any market power, no ability to fix its own prices. It just has to take the price that's out there in the market today or whenever they're planning to go to market. So economic structure has all of those things, and any economics textbook will deal with that. Then, of course, the legal dimension of business structure has a variety from the single entrepreneur, sole trader, single business organization, family-owned business usually, partnership, a number of people usually starting up or joining together in a partnership, and that's very common in professional services, legal services, and architectural businesses. They're often partnerships. Traditionally, a partnership doesn't have limited liability, so it was just like a sole entrepreneur. You start as a single business creator, and you risk all your wealth. If you're a single business owner, then if you get into serious debt and you can't actually pay your debts, your creditors can come and sell all your assets. Basically, they can get your house, any asset you have. There's something interesting in the news just at the moment about all this kind of shared economy, the gig economy and so on, where people are putting capital together as if they're in a big partnership. And the big legal issue now is whether they can actually, people doing that, I don't know if anybody's involved in it, big issue of whether they can actually be pursued right to their own basic personal property if they get into debt. So again, that's something you have to be wary of if you think of joining any of those kind of schemes to do something on the internet with lots of other people. But nowadays there is also a limited liability possibility for partnerships. So there are many law firms now are limited liability law firms. And of course, limited liability was the invention of the British way back in the 16th century, where for the first time people were legally allowed to put their capital together and create limited liability, so that in the business they could only be taken for the amount they had put into the business, the value of their share in the business. So you cannot, if you're a owner in a limited liability business, shareholder and owner of some kind, you can't be taken to court for debts to be taken from your personal property, your home, and so on. So that was a great thing, and that's really the very basis of the modern industrial revolution way back in Britain and Europe in the 18th century particularly. So we have that ability for people, and that's why companies grew and so on fast, and industries developed under limited liability. People could invest as much as they thought they could risk losing, so it encouraged risk-taking, and people lost money, of course, in big ventures sometimes, and lost a lot of money, but the ones that succeeded became the big companies, and often the basis of the sort of companies we know today. And those are, of course, private companies. They have limited liability, but besides that, there are all sorts of other mixed things, non-profit organizations, public limited companies, public sector corporations, all kinds of mixed things nowadays. So legal structures are seen across a wide range of business and enterprise and activity. Then when we look at the financial and accounting structure, you have if you're starting a business, people who put money in first of all are the original equity holders. Equity is your ownership interest in something. Equity is also a term used for fairness and so on, but this is quite a different use of the word equity. The equity you have in a business is your ownership share. The equity you have in your house is the part you've actually paid off the mortgage on, and you own the equity in your house, which is your ownership share until you've paid off the rest of your mortgage, and then you have the full equity ownership in your property, in your house. When you have put equity capital into a business, whether it's a private business, small business, a sole ownership, and then you make profits, and you take those profits out or you distribute those profits, you keep some back and add to the capital of the business, and that's called reserves. So the equity and reserves in a business are what the owners have. They are the ownership part of the business itself. Debt, of course, is when you borrow, and businesses borrow short-term from banks, long-term with securities of some kind. And then, of course, we have the accounting for assets, the assets of the business, what the business owns or is owed by other people. That's part of assets. And then you have liabilities on the other side. That's what you owe to other people. And the equity can actually be seen, in a sense, as part of the liabilities of the business, because it's the business as a separate kind of legal entity is seen as owing whatever the equity in the business is worth, owing that to the shareholders. That raises this question of the legal nature of a business. The business entry convention is that any business is a distinct entity from its ownership, and that is true in law, even if you are one of the sort of sole traders or sole owners who has a great liability to pay all his debts. So that's a kind of slight rundown. That's a very, very fast rundown of a wider kind of view of the structure of a business. And right, so we're now interested mostly in the financial and accounting structure of a business, and the core essence of any business really does lie in its finances and accounts. If you think of what is BP and you want some information about it, you go to its accounts, and you can go to its accounts on the web just by typing in BP PLC. An important economic determinant of what a business entity is what it wants to do internally and what it can depend on other businesses to supply to it. And the sort of core or the ring fence around a business enterprise is really determined by transactions costs, how much it costs to rely on external suppliers rather than produce the good or part of the good or service within your own business entity. So transactions costs are an important determinant really of whether a business includes a lot of activities or whether it specializes in one activity and then relies on other businesses' productive, real goods production and services of all kinds for the business. And businesses change their structure in that sense quite often, and often they build a bigger and bigger organization doing more things, and then they find they can't control it all very effectively or efficiently, and so they start selling off part and concentrating, as I say, on core business or core competencies and so on. And all of that, involves deciding about these transactions costs. And that's really economics. But money, of course, is at the basis of all this. Money flows in and out of the business for supplies and so on, and also for all those inputs that you want to depend on another business for. There is a famous biblical saying that the love of money is the root of evil, or the root of many evils, but it's the root of all business activity, and everything about a business accounts is really about money or things that you measure in money. So that, as I said, I'm starting outside accounting really and asking a few basic questions. What is money? Well, for a lot of history in the eastern part of the world, the little money cowrie shell, there with the little boy in the Maldive Islands looking at his money cowries. The Maldive Islands and that part of the Indian Ocean used to supply the world's trading currency from Africa to China. So this was money, and it was a very good form of money because it was something that you couldn't just manufacture. It grew very slowly, and the traders sold rice and so on to the population of those islands, and they got this money in return, and the Maldivians and Laccadives and so on in the Indian Ocean were producing this money for half the world. Then, of course, we went on to a global silver standard where silver dollars and so on became the main currency. Gold was sometimes used as well, and countries would exchange gold if nothing else was available, or they hadn't earned any sort of other currencies. Gold was always and still is a kind of ultimate money. Nowadays people seem to be going for more money and got more gold holdings when there's a lot of uncertainty in the global economy. Then, of course, the Chinese invented paper money, and this is a Ming Dynasty flying cash form. And it was tried a few times in China, but as always, since then and since, the banking system started to issue too many of these paper currency notes or promises, and they couldn't then fulfill the promise to exchange them for the little yuan, the little coins. So the system broke down and got resurrected a lot later on. But of course nowadays we have paper money everywhere, and we have even virtual money on the. This is a new gadget I've got here, so I keep pressing the wrong button. Sorry about that. Bitcoins, a totally computerized form of money, which depends for its scarcity. The fact that it can, we hope it can avoid the sort of paper money problem of being reproducible. It's very difficult to reproduce bitcoins. You have to solve very complicated equations, and you have to use an enormous amount of computing power to create one more bitcoin. So that's the claim it has to being a reliable currency, but I think some people still have some doubts about it. General question is, does a flexible economy need a financial sector? Some people would say it's very much parasitic on the real economy, and we've certainly had some kind of reason for thinking that in recent times, when we've had so many scandals and so many people making a lot of money for what some people might think doing nothing very important. But in modern economies, you do need financial intermediation. You have to have some very increasingly complicated system, usually, of transferring funds from people who save to people who want to invest and and do all kinds of other things. And once you get that kind of intermediation and money being very important, and it's been for a very long time, then you have to have an accounting system that looks after the flows of money in and out of businesses and in and out of business activity. But of course, money nowadays doesn't really consist very much of banknotes or metals or anything. It's basically items on financial balance sheets. So your bank money, the amount of money you have in the bank, is not notes that the bank is holding for you or anything like that. It's just a record on computers in your bank. It's nothing more than that. And so it is the bank's balance sheet items. In the former Soviet economies, banks were simple bookkeepers. They didn't really make any decisions other than obey the instructions to transfer purchasing power from one bit of the planned economy to the other. But in market economies, and almost all the world is now a market economy or market economies of varying kinds, changes in banks and banking systems make huge differences to everybody in the economy. So when banks change their balance sheets, they influence everything. They're not just kind of recorders of accounts at all. Oh dear, I'm sorry about that. So we're starting accounting proper then by looking at the simplest traditional form of a balance sheet. It's a stylized balance sheet, but it's one that actually balances because it includes as liabilities the shareholders' funds, the shareholders' capital and reserves. One way of looking at liabilities and assets is that liabilities are the sources of funds used in a business and assets are the uses of the funds. So thinking about how a bank started, all banks started with some kind of shareholders originally putting money into banks, or an organization issuing shares to get the original capital for the bank to work. And in Britain, banks started in coffee houses in London, with people with capital getting together to set up a bank. Indeed, the Bank of England was set up in that way. When you earn profits, and some of those go into reserves, and that becomes part of shareholder equity interest in the bank or the company. Banks can get funds. A source of funds is borrowing from each other. That became a very big issue when we had banking problems some time ago. And then, of course, most banks take deposits, small deposits, big deposits, and so on. On the other side, banks have what we call liquid assets, which are cash or near cash, money in another bank, or particularly in the central bank, or things that can be turned into cash without losing value when, for example, the central bank buys up monetary securities. That's what we call quantitative easing now. The Bank of England and many other central banks are putting cash into the banking system effectively by buying up securities, government debt, government securities held by people and banks and so on. You can have money market loans, the other side of the interbank lending. Banks put money into fixed interest investment securities, public securities, private securities. Other kinds of investments we might look at: mortgage loans, personal loans, and of course business loans. So all of those are the assets of a bank, and they are a use of the bank's funds. And these things have to balance. And if something goes wrong on the asset side, some of those loans and so on become worthless, then the main first to suffer are the shareholders. So the shareholders' capital value goes down, or reserves get used up and so on. So that simplified bank balance sheet provides pretty clear information. It's a very basic model. I think nobody has any difficulty understanding that simplest of models of an asset, a liability asset kind of model. But businesses have to give account of their doings and their use of money and so on, and their sources of funds and their uses of funds. And they have to provide information for all kinds of decision makers. The shareholders, of course, are the first ones to want information about how the company is doing, but its customers may want the information, competitors want the information, employees may want the information. Suppliers should be very interested in various ratios and figures in a company's accounts. Lenders to the bank, its creditors, lenders to the business, its creditors, including banks and so on, will want to keep an eye on what the business is doing, how it's moving on from one year to the next. And of course the government wants to know all about the business because businesses have to pay taxes. Analysts want as much information as possible because they are looking at all the businesses that they have taken an interest in, and they're advising people who want to buy shares in different businesses whether they should buy now or hold on to their shares or sell their shares because the future prediction is not so good. And then from the management point of view, the management accountants need to know what the business has been doing recently and what trends and so on have been happening within the business. So all of that is the information side of accounting. And once again, I've done this stupid thing. So go back there to keep my finger on that. So there are two main branches of accounting requiring different kinds of information sometimes. Management accounting is the kind of information we look at next time. That's designed for forward planning in the interest of the best shareholder wealth position. It's largely based on past financial accounting reports, but of course, as management accountants, they need to have more than just past information about the company. They need often confidential information that's kept within the company. They have to have speculative ideas about, how the company could, how the company could do better. They have to forecast and adopt strategic elements of accounting, and of course that involves weighing up those risks and so on, which is what business enterprise is very much about. So management accounting obviously is much wider and goes into other areas, including economic understanding of the market and so on. And that is much, much wider than financial accounting, which is what we are thinking about when we're looking at the assets and liabilities of a company. And as I said, for all interested decision makers, it reports past performance and the state of the business. And in order to do that, it needs standards. It can't just do it in its own way. So accounting has to have standards for information disclosure. So let's look then at what we've been leading up to, and that is the financial statements of a major enterprise, which I said is BP. It used to be, of course, British Petroleum. The first major statement you'll find in the accounts, and it doesn't arrive till about page 96 in the current accounts, so you have to flick through an awful lot of BP, on an awful lot of screens if you pull up BP's accounts for 2015. I think the first one you come across, important one, is the cash flow statement, and that is about cash coming in and cash going out over a given period. Then you have the income statement, which is otherwise known as the profit and loss account for a given period. And then you have the balance sheet, which is a statement of the assets and liabilities, the position of the company at one date. That's either the end of the calendar year or the end of the financial year, maybe April or that depends on the business. So those are the three big ones, and we look at them in turn and see what they look like. So last year's cash flow for BP said at the start of the year they had 29.7 billion or nearly $30,000 million in cash. And although it's not an American company, oil and everything is done in dollars. Oil prices are always in dollars, and even a big company like BP does its accounts in dollars. Then it gets that's the cash it starts from. It gets then cash from its operations over the year, and that came to $19+ million. Then it can get cash from investing if it's invested in another company outside itself, or it can use up some of its cash, and that's a negative amount. Accounts use the convention of putting negative figures. They don't use a negative sign, a minus sign. They put the figure in brackets, and on spreadsheets that is normally red, put in red as well. So I've done both. That is cash used in investing, and then you have cash used in or cash from financing activities, and here it is used up in financing activities. So this is, and financing activities of course means paying for interest and paying interest on debts and things like that. Investing is in putting money into new business activities. And so if you add those up, they come to a closing balance a bit less than you started with, of 26,389 million. So that is a cash flow statement. I really must get this thing. So to go into those elements in a little bit more detail, the operating activities that we're talking about are not quite straightforward cash transactions. They have to be adjusted for depreciation, for movements of inventory. That is when a company is using things, stocks of oil, perhaps in the case of BP, it's using things that were paid for at another time, but now they're being used, and so that is when the cash flow element comes in, but there isn't actually any new cash flow because it was paid in the past. So accountants have all these sort of rules about what they put in under cash flow. It's not just as straightforward as it looks. Then investing activities, fairly straightforward. Physical capital expenditure on new property, plant, equipment, and then financial investments, because BP, like many companies, buy ownership of part of other companies and so on. So they own some kind of shares that they invest in financially, and they buy government securities, other kinds of investment that pay interest. Financing activities are, of course, servicing equity and debt. So that is paying out dividends to the shareholders out of profits. It didn't make any profits last year, but it still pays out dividends from its cash in various forms. And those financing activities are counted as cash flow. Long-term, short-term debt. Long-term debt is where they have long-term financial securities that people have bought and hold, and then so they get a higher interest rate on those than short-term debt. And short-term debt for a company is mostly borrowing from banks. So that's the first big statement, first big financial statement. The second one is the income statement, and that's not the same as cash flow by any means. It starts with the total of its sales and other revenues that come in over the course of the year. It's mostly sales of oil in BP's case. Then every kind of cost and expense that is, according to the accounting rules, every kind of cost or expense then goes into what is called cost of sales. So in order to do those sales, the company has to incur costs of all kinds, and that involves buying in all sorts of things, including oil from other people as well as what they produce themselves. Then if you take off the cost of sales from the total revenues, you have the profit before interest and taxation, which is in negative figure, so we're looking at negative figures here. All the way down we're looking at negative figures, though one of them is a good negative figure if there's such a thing. Well, there is here. So you've got a number of big totals in the more detailed accounts. The accounts show you components of costs and so on. But these are just the bottom or intermediate bottom lines of these categories. So, and then you have interest to pay on debts of all kinds, so lending to the company. After that you get profit or loss in this case before taxation, and then you have taxation. But that's the one good negative figure because they've been making losses over previous years. They can claim for those losses against their tax liability for this year, or working out the tax liability. So, of course, taxation is always paid a year after, so that would relate to losses made last year, or the previous year, 2014. So overall, they made a loss, but as I say, they've got plenty of cash and plenty of reserves and so on to pay out to shareholders. And so I still get my dividend on BP shares, which weren't a good investment in the end, but might pick up again. I still get my dividend more or less the same as last year, I would think. So in that sense, shares in a company are often very close to a fixed interest kind of security. Big companies don't sort of pay out dividends, big one year, small, lower the next year. They will only reduce, the payout of dividends on the shares if there's really a long-term sort of idea that they're going to go on making more and more losses or whatever. So they keep up the value of the shares for the shareholder by paying out dividends, even though in this year they've made no profits at all. They've made a loss. So dividends are not just a share in the year's profit. They are part of the strategy of the company to keep their shareholders' wealth up and keep the shareholders happy. So that's an important feature that people sometimes don't realize. So in the income statement, profit and loss over an accounting period, as I said, we have total revenues less total expenses, measures the inflow of economic benefits against the outflow of economic costs, and the flow of annual net benefits adds to the stock of shareholder wealth or reduces it, and in the financial sort of sense, shareholders' wealth can be held up even though profit and loss can alternate sometimes. This is a cost-benefit analysis. I'm introducing this term. It's not these are not the terms usually used in accounting. These are economics terms and financial consultants terms and so on. So we look next time at the basis of cost-benefit analysis in a general sense, but mostly it's just financial analysis we're dealing with in a cost-benefit sort of way. And the benefit, of course, is for the shareholders, and the costs are what the company bears on behalf of its shareholders. It's a backward-looking analysis. It's a year and the year before that, and so on. We'll come across the term cash flow again in my next session, next time I meet you, because there we're looking forward in a net benefit, cost benefit analysis kind of structure. And that is the management accounting or the financial consulting kind of activity of setting up projects and business futures and doing it in a cost-benefit framework. So that's the difference between a backward-looking kind of cost-benefit analysis, a financial analysis of what has happened in the past, and then the forward-looking planning kind of thing that management accountants and financial consultants and so on get engaged in. So the cash flow statement versus the income statement, they're not at all the same thing, though in a very, very simple model they would be. Cash flow statements give information on something called liquidity. You, I'm sure, are familiar with that term. It means different things, so there's not one just definition of it. But in this context, liquidity means just being able to meet your bills when they fall due. You have the cash and you can pay. In general economics terms, liquidity is being able to get money very quickly. If you have to sell an asset, you can get your money back quickly. If you have to sell a house, you can't get your equity value out very quickly, so a house may not be a very liquid asset. But if you have got a short-term loan document that you can sell, if it's short-term, then you can get more or less the full value of it that you put into the money into it. You can get it back quickly, so that's a liquid asset. But liquidity here is just ability to pay the bills. In other words, to get the money quickly so that you can pay your bill on time. A similar idea. But that's quite distinct from profitability. You can have a good cash flow, and certainly BP has a good cash flow, but it's still loss-making. So the two don't go together at all. And of course, you can have a very profit-making firm on paper making lots of profits, but it hasn't got the cash, ready cash, to pay its bills. So quite a lot of firms, often small firms, not big firms because they can always borrow and so on, but many small firms have failed even though they were technically profitable, but they just got themselves into a situation where they couldn't meet their bills when the creditors demanded money from them. And so they get forced into liquidation or reorganization and so on. Income statement also is more complicated than it looks at first sight. It has elements not matched by cash flow in the same accounting period, and this is where those standardized rules of accounting firms come in. Inventories of raw materials or inputs are used up, and that adds to current profits, but you've paid for those in the past, so you're not actually having a cash outflow at the time, but that past expenditure then becomes part of current profits without a cash flow. Sales are often on credit, and the accounting rules say if you've made a definite sale and the buyer is contracted to pay you the money, then you can count that as part of the current income of the company or the firm, even though no money has yet been received. And then some sales in a year will be part of a long-term contract that may have been paid for in the past or is paid for at intervals other than the simple accounting period. So all of these things mean that the income statement has accounting rules which are very different from just cash flowing into and out of your bank or your banks. And that is called the accruals basis of accounting. Accountants determine the accrual of revenues and expenses. That is the defined date when you can actually put it down as a money flow, as an expense or a return for your profit and loss accounting. So accruals of revenues and expenses are what accountants have rules for determining. And so accounting is not on a cash basis, it's on an accruals basis. Accrual is just when something becomes relevant to the accounts. And then thirdly, you have where we started with a simple bank balance statement. You'll see that this one is different in different formats. The old traditional classic format was 2 columns, and you had complete balance because all liabilities had to be included, and that included liabilities to the shareholders. Now you'll see that liabilities and assets in modern accounting don't balance. So you'll see here that you have the total assets, you have total assets, you have total liabilities, and they're not in balance. But you have very, very clearly something else. You have the difference between those two being net assets, and that is a positive net assets figure when you take that from that. And of course, that is then the value of equity in the company. That's the ownership equity figure. So in traditional accounting, the old-fashioned accounting, uses of funds, source of funds, uses of funds accounting, that was just included as one element in liabilities. Now it's separated out, but when you put the 2 red figures together, you get if I've copied them correctly from the accounts, that they should add to the same as total assets. So then the other thing that you have to, perhaps term you have to learn, that is the non-current and current. Fixed assets, other non-current assets. Non-current means is essentially longer term or long term. Current means short term, operating period kind of data. Non-current is what economists would call long-term assets. Current assets are things that are ready for use, just short term, you won't have them for very long. They're part of your operating period assets. We look at what they are in a moment. So you've got the fixed assets and the other sort of things that are like fixed assets. They're long enough to be fixed, and then you have current assets to give you total assets. And similarly with liabilities, you've got non-current liabilities. Those are long-term debts, and current liabilities are short-term debts. Liabilities, what you owe some other entity or business or bank. So non-current assets, long-term, in the nature of fixed assets, property, plant equipment, and so on. Current assets, short-term, required for the firm's operating cycle. Inventories, receivables, that's what you are due to be paid from other people you have done something for or sold something to. And of course cash would be included there. Current liabilities are short-term. They include trade payables, what you have contracted to pay some other entity, some other business, and you haven't yet done it, so you've got it there on your books as something that has to be paid. Non-current liabilities, long-term borrowings on debentures or long-term securities, bonds, I think is the more common term nowadays. Then you also have something which can figure little or a lot in accounts, and that's called intangible assets. And these are things that make for good business once you've accounted for those obvious assets we've looked at. They include things like goodwill, possibly product brand reputation. They go on the balance sheet where it is possible to get a believable value for them. And that's usually called an arm's length valuation, something you can get from some market kind of valuation. So, for example, if you've taken over a firm, as BP has done quite often, if you've taken over a firm, it's valued to include a certain amount of what's called goodwill. They're selling you the access to their customers and so on, so they have created goodwill among other businesses, and so you have to pay for that kind of thing, which is an intangible asset. Other things like patents, copyrights, licenses can have a known or an estimate, a value that can be estimated, and things like staff transfer fees, things like that. So BP, maybe not quite so recently, about a year or two ago, bought into an Indian group, Reliance, and so they paid a significant amount for the goodwill of that Indian company. Then, of course, the things that you can't put on the balance sheet, which are the values of top brand names. There are estimates made of these, but they're not. The accounting rules don't allow Google to put part of its assets as the $66 billion that WPP valued Google at in 2007. WPP is the big London-based marketing and advertising organization, the biggest in Europe, I think, one of the biggest in the world, and they do these kind of things as other people do. General Electric, Microsoft, Coca-Cola, the top four brand name values in WPP's reckoning a few years ago. Accounting is still predominantly done at historic cost. That means you record expenses and so on, or sales, at what they actually cost you or somebody else at the time the transaction was done. That's the main international standard benchmark system, and it's got weaknesses, but it is favoured because it's objective. You've got invoices that accountants can look at, auditing your accounts, and all of that. There are paper records and so on. But of course, what assets, the physical assets you have, are being used and they're depreciating. So you write down the historic cost to book value. So the book value is the original cost you paid for your factory or your vehicles or so on, but the book value is the written down amount that has to go in accounts where you have to take account of depreciation. But there is a relatively new set of standards, and we have an International Accounting Standards Board, and this is called fair values, and that, of course, becomes much more subjective. It's not objective in the sense that you don't have all the invoices and things to prove your case. So it's required now by the standards boards and the international board because many historic cost figures can become misleading. And so if you've got a huge increase in property value since you bought your property, or if you've made huge losses on property, or you've bought lots of raw materials, say copper, when the price of copper was very high and then the price of copper slides way down, then you have to enter those sort of impairment of your assets, and you have to put in figures that are not the historic figures, but you have to make clear that you've done so. So the accounts have to distinguish very closely and clearly what your accountants have done there in impairment and revaluation to get a fair value of something. But of course, that can be criticised very, and often is, because it gives scope for creative accounting, and of course for malpractice, because people can put in values and persuade auditors sometimes that they are fair values. And as we know too well, we've had bubbles recently in property values all over the world. We've had banking crises that had people showing huge figures for increasing asset values and getting massive bonuses based on the values they had created, when those values were liable to disappear when the bubbles burst. Among non-current assets, there are things called derivatives, and those have been one of the big kind of things that mostly don't go into balance sheets, but they have often created big losses in balance sheets because they are used for many purposes. They're used for good insurance purposes and so on, but they're also used essentially for gambling without any real payment either way in the end happening until somebody makes a big loss or a big gain. We'll come on to that in a moment, or maybe after we've had a little break. Current assets also include derivatives, so derivatives can appear, so they can appear in both current or non-current assets. So we have current liabilities, payables, accruals, provisions, non-current liabilities, longer-term things. In BP's accounts, that includes quite a lot, and many companies have had this as well, quite a lot of deficits that have to be compensated in the pension funds. So this is again is a big current issue. Many firms are showing much lower profits after they have added money to their pension funds, because pension funds have become a very big issue. So that's it. So can we trust accountants for all these uses and so on? Firms have to have an audit by professional accountants and accounting firms, and their accounts should be relevant to the decisions that people want information for. They should be reliable, sufficient for people to base their decisions on, whether to invest or do business with the company and so on. They have to be comparable over time and across businesses. That's why we have these standards. And a big, sometimes questionable thing, they have to be understandable, not just by accountants, by, I think I would say, reasonably intelligent and reasonably educated people, let's say. But some recent history hasn't been fully reassuring. You had the amazing sort of case of Enron in Texas, where you had a company where the top executives had all kinds of little companies that they put losses into, and they managed to hoodwink their accountants. They managed to hide all those losses and produce a nice rosy picture of how the business was doing. But in the end, all of that came to a sharp end, and shareholders lost $11 billion, employees lost their pensions, suppliers lost their money, and the accountants who at the time considered themselves the top accounting firm in the world, Arthur Andersen, collapsed. So the company managed to hoodwink, managed to deceive the highest rated accounting firm in the world. And Arthur Andersen operated all over the world, and their company was broken up, and other accounting firms bought bits of it and so on. Then, of course, we had Lehman Brothers, AIG, the famous Bernie Madoff with his pyramid schemes. And these kind of scandals include often the term off-balance sheet, so keeping items off-balance sheet when they're risky and they potentially incur losses. And of course, when they do, then the whole sort of system falls apart. And more recently, there we've got Tesco in Britain, which is still having some law, some case of law, because they wrote into their accounts things that were somewhat uncertain about money they were going to get back from some of their suppliers for example, putting the supplier's goods in prominent positions in the store, and whether you know it or not, suppliers to big supermarkets do pay supermarkets to display their goods before other goods and put them in special positions and so on, and they grossly overestimated what they could, money they could, screw out of their suppliers, and that eventually was reckoned to be a very big cheat on shareholders, and so shareholders are now taking Tesco to court over that issue. So I think it's time we had a break, a little break. I'll talk to you next year. Has everybody signed the attendance sheet? Looks as if some people are disappearing. If you signed it. Okay, can we begin again, please? Main things we're going to look at are ratios that you derive from financial statements, ratios that are then used by people to give a broad kind of picture, not a detailed picture of how a company is doing. And then we'll look at a part of accounting which is new. It's called full costing, and it departs from traditional ways of looking at activities in a business. First of all, there were a couple of slides I didn't do at the end of the last session, or just a moment ago. The accounts of a company like BP include quite significant items called derivatives, and these are there are many kinds of derivatives. There have always been, or at least for a long time, there have been traditional derivative contracts called forwards and futures, and these are contracts to buy something at maybe today's price at some date later. So there are markets where you can either over the counter make a definite deal to have the delivery of some foreign currencies at today's exchange rates. If you think the value of the dollar is going to go a lot higher or is going to go down, then you might even create if you think the dollar is going down in price, you could try to get somebody to contract with you to buy dollars from you at a certain price below today's price, say, and that person might think that's attractive enough to take up your contract offer, but you expect the dollar to go down even more than he does, and so you're taking on that contract even though you might lose if the dollar doesn't fall and you have to pay more for the dollar on the day next month or whatever when you're going to deliver the dollars. So you take these risks, and people want to buy these sort of things because they want certainty. They've got some payment they know they're going to have to make at some future date next month, say they need dollars, say, and so they want to be sure now for planning purposes and so on. They want to know what price they will pay for the dollars at that future date. Those are traditional sort of things. Now, the over-the-counter forwards are different from futures because forwards are a contract you have to stick to. Futures are things that have a market for those contracts. So if you no longer want the contract, you can sell it on to somebody else. And so somebody else will then take over that offer of dollars at a certain price that you have made, or the other person can sell the contract and so on. So there is a market repricing these contracts, and that's a daily. Their price goes up and down daily. So you have these documents, if you like, or I suppose they're on computers nowadays mostly. They are contracts that are for purchase and sale of oil, and in the case of BP, of course, it's futures markets in oil. And you have futures markets in commodities of lots of kinds, metals and so on, where they're in the daily financial press every day you'll see prices for futures values, futures markets price for copper and even pork bellies, believe it or not. Chicago market in pork bellies, pig meat, So you can buy that. If you're a big catering firm, I suppose, you would have to want to get your supplies at a particular price at a future date, and you go into the futures pork bellies market. So all sorts of things, commodities, currencies, interest rates, and so on are there. And as I say, BP has derivative contracts of this kind on both sides. It contracts to sell oil at certain prices in future, it contracts to buy oil at certain prices, and it engages in currency futures and so on, because BP is operating in all sorts of countries, and it is going to need currencies of all kinds, and so most big companies operating internationally have a department that are all the time looking at how different currencies are going and making contracts to purchase and sell currencies at rates which they fix in advance. So all of that is very big in the accounts of BP. A different kind of contract is an option, where you have a contract but there's no obligation to deliver unless it works in your favor. So it's an option. You take an option, or you put an option. You take an option to buy, or you put an option to sell something if something else is true. So it could be foreign currencies based on what the exchange rate was at the time when you at the future time. But if the rate is not as you specify, then you don't have to fulfill the contract. So those sort of options are things that people make many of, and that most of them don't actually end up in a real financial contract of buying or selling currencies or government bonds or whatever. But the ones that do result in some real business transaction, they are then included. They are called embedded derivatives. They're embedded in the BP's income statement as gains or as losses. And those futures can give rise to loss as well as to gain. There are swaps you can contract if you've got some kind of risky cash flows that you're expecting. You can get a swap. Again, a lot of banks have got into trouble selling those. Most big British banks are in trouble for swaps they made when interest rates seem to be going up. And so lots of small businesses now are taking legal action against those banks because they were sold swaps at quite a high interest rate to guarantee that interest rate for the long term, because the businesses were led to believe that the interest rates would be going up over the future that these businesses were interested in. And instead, of course, the interest rates went down and have gone way down and so on. So they are, complaining. You could say they're complaining without reason, but they think they were badly advised, and the banks were too ready to sell them these things and so on. So this is a swap, and of course they were credit default swaps, where at the center of the crisis we encountered in 2008 and 9, because all of those institutions that were buying and selling mortgages and putting mortgage securities together into mortgage deals and contracts together into big collections of mortgage contracts, they would then go to an insurance company like AIG in the United States and buy and swap these contracts for a fixed kind of interest return. And that was part of the crisis that we saw in the banks, and many of those agencies, indeed AIG, were seriously in trouble and had to be bailed out, and in the end some of the big American financial agencies collapsed, and the most famous one was the Lehman Brothers collapse. So swaps were involved there. So derivatives, they provide prudent insurance if you want to insure yourself against a big rise in interest rates or currency rates, for example. But then they also open up all kinds of speculative opportunities for people, and all kinds of investment banks and other financial institutions wrote contracts in the trillions and trillions of dollars, way beyond any of the kind of orders of magnitude of money in banks, and even way beyond the national income of whole countries. There were contracts out that if they'd all come to maturity or fruition, all cashed in and so on at the same time, they would have been more than the whole of the income of everybody in the world. So this speculative activity got really out of hand. Now, as I said, BP does engage in some of these speculative things, but they have prudential or prudent limits that they're allowed to do. And most of the hedging and so on in BP's balance sheet is really for currencies, oil, gas, and so on, and various swap agreements and options that they find useful for, essentially for insurance. But they do engage in speculation as well, and they are limited in how much of that speculation of a financial kind they can do. But most big companies use money in all sorts of ways, and that includes speculative opportunities in trading contracts of this kind. So let's then go to what the second part is really about, and that is the financial ratios that you can derive from the accounts of a company. Simple summary statistics, and they have potential for assessing a firm's performance this year and comparing it with last year, and so on. I put in some potential because they are very rough and ready kinds of indicators. And we're only dealing with two real categories. One is profitability, shareholders' interests in these things, and then gearing, which is also called leverage or leverage in American pronunciation, I think. And of course, this is the extent to which a company relies on borrowing rather than on equity investment by shareholders. So we're going to look at five of these things. One is called return on ordinary shareholders' funds. One is called return on capital employed. One is called operating profit margin. One's called gross profit margin, and then the gearing ratio. So we take those in turn, and I've set out examples and little arithmetic examples based on a set of accounts here for an imaginary company, and it's set out in the way that we have talked about in the first half. It's got non-current assets, it's got current assets, maybe not the same order as the previous one, but it's okay. And then it's got the equity set out, the ordinary shares of the company in 2 years, 2008, 2009. It's got non-current liabilities, which is finance debt, loan stock, or debentures, and that has gone up between the 2 years. It's got current liabilities, including finance debt, which is bank business. So the bank, they didn't borrow anything from the bank in 2008, but they borrowed 152 million from the business from banks in 2009. So those are figures. If you will be able to see these on the Blackboard website and look at them in more detail. Then we have the income statement. So you have the revenues of the company. You have the cost of sales, and then you have the gross profit. So you've got, these are the important terms that we've just mentioned in the ratios that we talked about. You have gross profit, you have operating profit, you have profit before taxation. And so the difference is that your revenues from sales, then you have the cost of sales deducted, and that is gross profit. So the gross profit is just the difference between what you sell and what you buy in, and buy in the way of goods and services in order to create the goods that you sell. And then you have the operating expenses. That is what you do to what you buy in, what you're processing and so on you do, and those operating expenses are then the next thing you deduct, and that gives you the operating profit. So after you've taken off the operating expenses, you have the operating profit. But shareholders, of course, don't get the whole profit, whether distributed or not, because there may well be these lenders to the company, long-term or short-term, and they have to get the interest on their loans, and so after operating profit you have to deduct interest payable, and that creates profit before taxation, and then you subtract taxation, and you get the profit for the year. So it's a straightforward series of deductions from gross profit, which is just the difference between what you buy in and what you sell. And of course, that difference between your sales and the cost of things that you buy in, goods and services you buy in, that is, in economics terms, that's called value added. It's also used in business terminology. And of course, value added is what almost every business has to pay tax on. So you pay tax on the value you add by those operating activities of workers and so on, working on the goods, and the capital having a return itself, capital and labor going in and getting returns and so on, and that creates value added. And then, of course, you have inventories, which you may hold a lot of, or you may hold very few nowadays, because companies like Nissan operate very much on just-in-time delivery of the parts and components that go into their cars. And that's rather different from the old days, when any big company, car company particularly, had to hold large stocks, large inventories of all the car parts that they were going to incorporate in their cars. That meant using a lot of the premises, the property that you had, buildings and land and so on, to hold those stocks. And they're called stocks in Old English. They're nowadays called inventories, the American term. So you buy inventories. If you're storing them, you buy them, and you may buy them at different dates and so on. So inventory accounting starts with the opening value in the year, at the start of the year, of the inventories. Then you purchase some in each year, and you get the total stock that you have after those purchases. Then if you're closing inventories, the value that you have at the end of the year, you subtract that from that amount, and you get the cost of sales element, inventory element that goes into the cost of sales. So you have inventories, and you account for them when you use the inventory raw materials. If you're a company using a lot of, say, making pipes or something out of copper, then you would have quite a large inventory perhaps of raw copper, and then you take it out of inventory and you incorporate it in the products you sell, and that then contributes to your profits, and so on. So let's look at these using those definitions. The return on ordinary shareholders' funds is straightforward, or it's not quite straightforward, because there is something called preference dividends. And preference dividends are held by people who come first in the queue for any profit distribution. And that, of course, that can add to the risk of shareholders who are not preferential owners of shares or in the company. I don't think they're so common now. They used to be much more common than they are today. But the technical definition of return on ordinary shareholders' funds takes the preference dividend, the preference shareholders out of the picture first, and then you divide what's left, if any of that has been deducted. You divide that by the ordinary share capital plus reserves. So this is ordinary shareholders' funds, and that is the value of the shareholding and the value of the reserves, past profits that haven't been distributed but still belong to shareholders. So reserves, I said several times, reserves are part of equity interest in the business. And that, of course, is the indicator in which shareholders have the primary interest. So that's the main thing that shareholders will be looking at in most cases. If we want to look at, if we went back to that set of little imaginary accounts, you would have it 1 year and the next year, 2008, 2009. If you've only got 1 year's accounts, then you would have the whole thing, just simple, the amount of capital there was at the end of the year, the amount of reserves there were at the end of the year, you would divide by that. If you've got 2 years, you've got the amount of capital and reserves at the end of the first year, which is the beginning of the second year, and you've got the figures at the end of the year, and they may be different. So therefore, it's best to take the average of what you start the year with and what you finish the year with, rather than using either one or the other. And so that's one reason for giving 2 years profit, just as well as, of course, the normal interest in seeing how the company has changed from the whole set of accounts. So averaging shareholders' funds at the start and at the end of the year is the normal practice, rather than taking the year-end stock of shareholder equity. Return on capital employed. Well, the capital employed is both the capital supplied by ownership and the capital supplied by creditors. So if you borrow money, either if you borrow long-term, non-current liabilities are long-term borrowings by issuing some kind of bond at fixed interest normally, then that is another form of capital employed in the company, and so that goes into the equation. And in this case, the profit is it's the operating profit. That is, of course, after you have included all of the operations cost of producing the good. So operating profit divided by all capital employed, and that is all suppliers of long-term finance, not just equity shareholders. And again, the figures for shareholders' funds plus the non-current liabilities, that it would usually be the figure at the start of the year or the end of the previous year, and the end of the year you're accounting for, same as in the previous one. We have something called operating profit margin, which starts with the operating profit and divides that by the sales revenue. And the reason for looking at this is that it's not affected by the finance structure of the firm, that is the gearing. It's not affected by how much borrowing has gone on to supplement the ownership, the owner capital, the ownership interest or the equity interest. So it is independent, therefore, of the gearing, which of course determines how much interest has to be paid before you get closer to a proper sort of definition of profit. So again, that's something that people may want to look at and compare across companies and from one period to another and so on. And that is independent of the finance structure. So if we use that, look at that imaginary, well, you can look at this for yourself. You compare the 2009 figure in those humdrum imaginary accounts for 2009, and you get an operating margin of 1.8, but last year, the previous year, it was 10.8, so that's one important figure. Obviously, the company has not been doing very well on that particular indicator. Then we have the gross profit margin, which is gross profit over sales revenue. And that, of course, was our first measure in the different levels of profit calculation. That was the first one, and it was just, of course, to remember the sales minus the cost of sales. And that is particularly of interest if those elements, both elements, are quite unstable. So if if your gross profit, if the cost of sales is going up and down because some of the things you buy in, suddenly if it's oil or something, the price may go way up, then may go way down, or you may have a very unstable price of your product, and so those two things unstable, and they may be more unstable than other expenses of the company, for example, and so you have extra information here for shareholders or anybody else who's interested in this gross profit margin. And again, people can obviously find out what is affecting the gross profit margin. Is it the cost of inputs? Is it the price that the company can get? And if it's the price it can get for its product that is the problem, then of course, then you start thinking, is that going to continue or is it going to improve, and so on. So again, it's a potentially useful little bit of data. And in the case of the years 2008 to 9, it's gone down from 22% to 16% for that little company, or big company. Then we have the gearing ratio, which is the ratio of those longer-term borrowings to the whole amount of capital that is employed in the business, the share capital, reserves, and the non-current or longer-term, usually fixed interest liabilities. And of course, this is one of the most important and sometimes the most critical of all these things, because companies can go overboard with borrowing capital and increasing shareholder risk quite dramatically, because they've had to borrow a lot more at fixed interest, and after that interest is paid, there may be a lot less left over for the shareholders. On the other hand, if these shareholders are risk takers, if they like the risk, they go for a highly geared company, because if the interest rate goes down, and they're expecting interest rate to go down, then there's a lot more left over for the shareholders themselves. So gearing is a risk indicator. High gearing, high dependence on debt, which you are committed to paying out on. You're not committed to paying out any dividends at all, though, as we said, BP will go on paying them out even when it's making losses, because it has the capacity to do so. But not all companies have that capacity, and so shareholders may be taking a big risk if the company is going for a policy of borrowed capital rather than owned capital. So leverage, it's It's a big risk item, and again, it's a big feature of recent crises. The financial crisis of 2008 onwards was set off by highly geared banks and financial companies, because banks started borrowing more and more from other banks and other financial institutions, and incurring fixed interest costs by doing so. The biggest example we had here was very close. It was our famous or infamous Northern Rock Bank. And Northern Rock Bank was actually failed completely before any of those American banks failed. So Northern Rock was the darling of the Northeast. It did a great deal for the Northeast because it had put a huge amount of its profits into a charitable fund, and people here benefited from all sorts of things. But an awful lot of people lost, particularly previous employees of the bank, who had put a lot of their pension and so on into shares in the bank. But what Northern Rock did was it started closing branches and depending less and less on getting deposits from the public and business and so on, and started borrowing from money markets around the world. In other words, other banks and financial companies. And so by the time 2007 came along, they had far more of their funding of mortgages, which is long-term lending, by short-term borrowing from banks everywhere, all over the world in the international global money markets. And so lots of course, that's what banks and financial institutions in America are doing as well. But the Northern Rock Bank collapsed. Its bad debts, it couldn't get in money from lots of mortgage holders. It actually, on the other side, it went overboard on lending, because it lent more than 100% of the value of a property that people wanted a mortgage on. So instead of requiring a deposit for your house, it would give you the full value of your house to pay for your house. It would also give you more money so it could buy furniture for the house, and so on. So on both sides, it was taking high risks. And when it collapsed, much of its assets, that was the lending it had done, was taken over by a government institution which is still managing those bad debts of Northern Rock Bank. The rest was taken over by Virgin, and it's now part of Virgin Money. So the good mortgage debt became assets of Virgin Money, which is Branson's bank, and has a branches now in Newcastle. So that's gearing in practice, and it's risky, as other aspects of Northern Rock Bank were risky. I think that was, so we had that. So yes, there's a little example there of the gearing. So for that particular company, management company, it became more highly geared from 26% to 36% between those 2 years. So again, some shareholders might have begun to get nervous by a 10 percentage point jump in the gearing ratio, and if they were risk averse, then they would maybe start to sell those shares and buy shares in another company that was less risky. Other people would have taken more shares because they were risk lovers, people who had plenty of money and want to take risks to make a bit more if things go well. Right, this second part, not too long, I think, is about full costing. This is a modern development in accounting It's all around us, because if you work in a business, you probably have to keep detailed records of your expense account, and you have to have them codified and put into the company's accounts under all the code numbers for how much you spent on your dinner when you were out on business for the company, how much you spent on hotel, everything. Newcastle University does it with the SAP system and so on. So full costing of a company's activities or a university's activities has all this. It's part of data, data management, huge data banks and so on now. If you go back to economics, or if you know anything about economics, economic models talk about firms in the short run and the long run. They have short run costs, long run costs. Short run costs are variable costs, long run costs are fixed costs. So that's the economics terminology. It can also be used in business context and so on. How do accounting procedures deal with these? We have lots of problems arising in allocating fixed costs, for example, to units of output. But when we come to look at investment appraisal, we'll be talking as if you can actually allocate the value you get out of machines or buildings, the whole sort of plant and so on that you've got, or parts of the plant. You hope to be able to attribute some of the earnings you make to particular elements of the business. So you assume that you can work, we assume you can, for example, in talking about working out a plan for replacement of machines and so on, you really need to be able to, if you're going to have a plan to replace machines after a certain time when they begin to be a bit more costly to repair and have more breakdowns and so on, you really need to know how much value that machine is to you, how much of your returns depend on it. And so that is part of investment appraisal, for example, of machine replacement and things like that. But you can look at a diagram here where you have economics, which divides costs into fixed costs, variable costs. Accounting usually divides costs into indirect costs, which are also called overheads, and direct costs, which are the current kind of operating things, not the amount you allocate to fixed equipment, plant and equipment. So direct costs are similar to variable costs, but sometimes they are less inclusive. In traditional economics, you talk about the labor costs and the materials costs. Indirect costs, overheads, are then all the other things, mostly economists' fixed costs. Conventionally, the way those things are accounted for is that fixed costs are added on top of the variable costs in a fixed ratio. So when I take my car for an annual service or repairs, they just put down labor costs, and the labor costs are the cost, basically, that I'm charged. But labor costs have a fixed element added on top of the actual wages and so on that it costs the firm to employ labor. There is a fixed element added to that for overheads. They don't set that out on my invoice. They just put in 6 hours of labor costs at £100 an hour or something like that. If they spend I'd probably have to pay £600 if they spent 6 hours. But they would just put 6 hours of labor costs plus all the materials and so on that they had to employ or use. So that's called the overhead absorption or recovery rate. You recover your overheads in a fixed ratio to the costs of labor, so maybe £10 added for each direct labor hour, but in many cases it's an awful lot more than that. Conventional approach worked quite well when overheads were a minor item and labor was the most of the cost of doing some production or job for you. But nowadays, with global competitors, high technology, capital intensity, robotics, all this, then often the fixed or the capital, the overheads and so on are many times the wage costs. So typically nowadays 5 to 10 times the actual wage rate would be necessary for overhead costs recovery. You could substitute nowadays machine hours or something, but we don't usually see that done. And so people now, accountants now look for other solutions. And what they're developing or have developed is called activity-based costing. The basic principle of that is that fixed costs or overheads are not just determined at time zero, that is the time when you invest in your new plant equipment and everything, your investment period, and then you say, well, we're going to try to recover that over an operating life of this equipment, and therefore we need this extra amount added on top of labor costs for every labor hour to get back our fixed costs or our overheads. And so we now talk about products or jobs that involve activities that cause overheads. So the overheads are not given from the start, they are caused by the way you set up your production of the product or the job. If it's a one-off job, I mean, if you're building a ship or something, then it's a one-off product and you can call it a job. So the activity might be, for example, using factory space in the way I talked about a moment ago, using factory space to hold inventories, half-produced product, work in progress, that would be called, and a variety of products awaiting sale. So in the old days, the poor British car industry would produce all sorts of cars in all colours that people might want, and they would sit and stand in hangars and in fields and so on, waiting for somebody to come along and want to buy them, or at least dealers come along to buy them. Nowadays, Nissan and other car companies basically try to keep very few cars, sitting out there waiting for somebody to buy. They produce them to order, and they get the incoming spare parts around just in time by all these data links with their suppliers. Big data now spreading across the world, and people producing things for clients or other businesses to clear specifications just for one-off jobs and so on, with information exchange easy nowadays. So you could use that old-fashioned idea, or you could go for just-in-time contracting supplies, and you control the production line to match the customer. Indeed, many of the cars coming off Nissan are specifically produced, as I think I said, for individual orders, the color, the accessories, everything. They don't produce every kind of car with every kind of accessory. They produce them as orders come in for that kind of car, that color of car, with those accessories and so on. And all of that happens over highly computerized production systems where you avoid all that holding of inventories and finished or half-finished cars and things like that. So when you do that, the same fixed capital is involved. They've still got the same factory space, but they can use more space for production lines and other activities, and you've got very different overhead costs. So activity-based costing then analyzes overheads into cost pools for each identified activity that drives costs. For example, so many pounds per unit of the product or the part's use of space per week. And accounting software on computers then allocates codes to all of these cost pools. And I think the most successful big provider of the software, the computer systems for this is SAP. It's a German company. Many big companies use it, and Newcastle University runs on SAP software, where, as I say, we have codes for every expense, every kind of input into all the activities of the university. probably hundreds of thousands of codes and identities and so on. Newcastle has its own success story. I told you of one very unsuccessful company, Northern Rock Bank, but Sage is Newcastle's big success story as a software producer for a global sort of market now in smaller and medium-sized company systems for managing and computerizing their accounting and their management accounting and so on. International accounting standards require full cost estimation of inventory. Inventory is work in progress in published financial statements. So it's now got to the stage of being incorporated into the accounting standards. But it's still open to criticism. It's still financial accounting. It's still based on historic cost normally. And if we want long-run analysis and decisions, we need management accounting and economics and so on. Again, we can't leave it to the financial accountants, even though they do much more now with this kind of costing. So forward-looking capital investment analysis, which is our next topic, aims to optimize all these things, fixed or indirect costs, as well as variable or direct costs. Inventories are then in the accounts. We've got, almost finished. I thought I was finishing, but just a few minutes to deal with this. There are three methods of accounting for inventories that are acceptable in accounting. They're accounted for in three possible ways. You value the things you use from your inventory either at the price of the last in and first out, or the first in and first out, LIFO, FIFO, or the weighted average cost of the inventory that you bought at different periods of time. So say you're buying in a raw material like copper or zinc or something, you will have bought these in at different times at different prices, and if you use LIFO, then you use the price that you paid for the last units. If you're using FIFO, you put the price of you multiply the amount you've used by the price of the first ones you bought, or the earliest ones, or you average all of the prices you paid over your total inventory. And international standards approve FIFO or average. They really don't like LIFO, though some companies might still want to use it. A firm has to choose one of those methods, first in, first out, or average cost of inventory, and then stick to that method over time. So these are the kind of figures, very, very simple arithmetic here. This firm purchasing oil and supplying it to local businesses purchased on January the 1st 5,000 tonnes at £310. A bit later they bought 12,000 at £340, presumably because they thought it would go up even further. And then they sold 5,000 on that date. The LIFO method says cost of sales is 5,000 at 340, which is the last price you paid, and so you took 5,000 effectively from that lot, though it could have been the actual ones you bought earlier on, but you still have to account for them at the last price you paid for 500 units. And so the closing inventories then are got in this way. You have 5,000 left, which cost you 310, 7,000 left, which cost you 340. So that's your closing inventory, and that's your opening. The cost of sales was that, and then you have a closing inventory of that. So you cost your sales at the last in, first out price. Then you do the same thing if you want to use the first in price, which is the one you would normally use anyway nowadays. So the cost of sales is 5,000 at the first in, the lower price, which was the 310. So that's your cost of sales. And then what is left is the 12,000 at 340, and that is the closing amount in that case. And then average is very obviously simple and straightforward. You work out the average price for these quantities at those two prices, and then you